Okay, so now we're going to move on with our third exogenous driver. We're going to be looking at interest rate differentials, and specifically we'll be looking at the interest rate differential between Australia and the United States. Now, the important thing to pick up in this video is actually how we monitor the interest rate differential over time, because it's not just about the absolute level of the interest rate differential as to whether it's positive or negative. It's also as important, if not more, the direction that the interest rate differential is moving in. Now, contrary to our previous analysis on balance of payments and trade, when we're studying interest rate differentials, it's actually a pretty straightforward analysis. So if you recall, in the foundation section of the video series, we monitored interest rates, and we also looked at, in our computational methods, we looked at carry and rollover. And this is what we're going to focus on now, but in a bit more detail. But the process is actually quite straightforward. So let's go over to the computer screen. If you need to go back over to the foundation, this is why we said right at the beginning of the video series, it's so important to get the foundation right. If you need to go back and go over that section first, then please do so, because if we take a further step now and start looking at interest rate differentials in a bit more depth. So we'll go over to the computer screen, and I'll see you at the end of the video for a recap on interest rate differentials. Okay, so welcome back to the computer screen. What we're going to do now is compare interest rates across two geographies, so across two economic regions, and we're going to be looking at the United States and Australia as our example continues. And when we look at relative interest rates, so the interest rates in two countries or economic zones relative to each other, what we're actually looking at is the interest rate differential, or carry. And it's important because it provides us with another driver to our analysis and overall scorecards. And specifically here in our exogenous analysis, because we're comparing two countries or economic zones relative to each other, and our analysis is going to provide us with a driver scorecard that gives us a long or short currency bias on the exchange rate between the two countries. So if you recall, right back near the beginning of the video series, in the foundation section, we looked at carry and rollover. We can do a quick recap here just to refresh your memory. But to fully understand this better, you should probably take some time and go back to the foundation section and look over that section again on carry and rollover in the computational methods. Now, just recapping on the carry rollover, what is actually happening is you're attempting to receive more interest on the long asset and pay less interest on the short asset. So the long side of the currency pair versus the short side of the currency pair. And the long side is in itself the asset because you're receiving interest on it. And the short side is really a liability because you're paying interest out, you're borrowing. So the phrase that we use to describe this in the Forex markets, between the interest you pay and the interest you receive, is the carry. And if you recall, a positive carry is a credit and a negative carry is a debit. So that overall equation, if it's positive, you're getting a positive carry, and if it's negative, you're getting a negative carry. And when we're comparing two currencies, it's important to know the interest rates in each country at which you can borrow and lend, because as we discovered much earlier on in the video series, if you don't know that, you could actually be right on the direction of the trade, but end up paying more out and end up making no money, or the currency pair may not move and you may actually end up paying money out, and in both situations actually lose money on the trade for no apparent reason. So it is a very important factor in our exogenous analysis to consider, because hot money or speculative money from the professional traders, so investment banks and hedge funds, the hot money, smart money in the market follows the carry and where carry is available. And at the time frames we're looking at, carry becomes very, very important, because we're not trading intraday. We will have a positive or negative carry over the lifetime of our trades if we're looking at a 1 to 3 month time horizon and trying to capture the big volatility in currency pairs. So if you recall, we provided you with a template in the endogenous driver analysis spreadsheet, and the template was split up into two sections. The first section looked at the differential, so the carry between two economic zones. And it's a theoretical template. However, you can actually plug the real numbers in and work things out. And we looked at two examples. We looked at the negative carry and we looked at the positive carry. And then we actually looked at leveraging both situations, both the negative and the positive carry. So go back and remind yourself of how this spreadsheet works before moving forward. It's pretty important to understand this stuff. What you see on the top here is basically what your brokerage platform will be working out on your behalf. But it's really important to be aware of the numbers. And again, you can get these either from the brokerage platform, a download on the broker's website, or request the information directly from them. You need to know this stuff, again, because if you don't, you're just shooting blind. You don't understand that if you put a currency trade on and it either moves in your favor or doesn't move at all, you could actually end up losing money. And if you recall, it's one of the classic retail trader mistakes, not understanding these numbers and what goes on behind the brokerage platform. And you can actually turn this into your advantage in the same way that professional traders do, by actually looking for carry. So what does this look like pictorially when we look at the historical interest rate differential between Australia and the United States? Well, we have this pictorially represented going back to 1997 on this chart here. We have the RBA, Reserve Bank of Australia, benchmark rate minus the Fed funds rate. And this line is represented on the chart in yellow, and represented on the chart in green is the Aussie dollar US dollar exchange rate. Up the left hand side, we have the interest rate differential between the RBA benchmark rate and the Fed funds rate. So this number here is a percentage, which is the RBA benchmark rate minus the Fed funds rate. On the right hand side, we have the Aussie dollar US dollar exchange rate. And you can see the data goes back to 1997 here when comparing them to each other. So in yellow, what happens when this rises? Well, what's happening here is that the interest rate differential is widening in the favor of Australia. And you can see the Aussie dollar US dollar exchange rate goes up. And you can see this here as well, and here as well. What you can also see is when the interest rate differential narrows, the exchange rate tends to fall. So narrowing here, and exchange rate falls, narrowing here, exchange rate falls, and also narrowing here, exchange rate falls. So the rule of thumb is that when the exchange rate widens in favor of Australia, the Aussie dollar US dollar exchange rate increases in value, and when the interest rate differential narrows in the favor of the United States, the Aussie dollar US dollar exchange rate falls. Now we can go over to the exogenous driver analysis spreadsheet and have a look at this data in more detail. So let's head over now to the exogenous driver analysis spreadsheet. If we just come out of the presentation, inside the EXO spreadsheet, you need to find the tab interest rate diffs and carry. So this is the one we'll be looking at in a second. And you can see we have the date, US Fed funds rate, RBA interbank rate, the interest rate differential, a daily rollover calculation, and a synthetic calculation. You will also have in the download section the spreadsheet for the RBA interbank rate. But if we go over to the sources tab at the bottom of the screen, you'll see to the right hand side of interest rate differentials and carry, you'll see the two links that will take you to the data. So we have our Fed funds download data, which is at the St. Louis Fed. This is the data that we downloaded earlier in the video series in the endogenous analysis spreadsheet, the effective Fed funds rate going back to 1954. So you can click here and download the data, no problem. You just open that up and scroll down and you'll see all the data is available there. If we go back to the EXO spreadsheet, we'll have a look at the RBA data. If you click on RBA, this will take you to the Reserve Bank of Australia website. And if you click on interest rates, the one that you want is actually the monthly rates. So not in exchange rates, sorry, in interest rates. So you'll find in interest rates here, interest rates and yields money market daily, and interest rates and yields money market monthly. The one you want is the monthly data. So you download this, and this is the sheet. This is the same data in the sheet that you have. So what you want is the interbank overnight cash rate, which is this column here. So this is the column C, that you need to concentrate on in terms of downloading the Reserve Bank of Australia data for the benchmark rate. So let's head over to the exogenous analysis spreadsheet again and navigate over to the interest rate differentials and carry. And what we have here is our date going up by months. We have our US Fed funds rate data, which we've downloaded. We have our RBA interbank rate data. We have our interest rate differential, which is column C minus column B. So the RBA interbank rate minus the US Fed funds rate. We have our daily percentage rollover rate, which is the interest rate differential, column D, divided by 365 days of paying interest per year. And we have our synthetic rollover worked out as the percentage daily rollover multiplied by a one lot contract of Aussie dollar, US dollar as 100,000 lot, 100,000 currency pairs. So what we are seeing here in the synthetic rollover is the amount that we receive or pay per day due to the interest rate differential. And here we can see that in May 76, due to the interest rate differential of 2.42%, we're paying spot 0.00662% or receiving spot 0.00662% per day. So the synthetic rollover on one lot is receiving or paying $6.62 per day. And you can see with the data, we're going all the way up to February 2015. And you can also see here that we have our Aussie dollar, US dollar data going back to September 97. Now, if we go back up to the top of the screen, top of the sheet, and we scroll across, you can see here the sheet or the chart that we were referencing earlier in the presentation. And if you recall, we're looking at the Aussie dollar, US dollar exchange rate in green and the interest rate differential in yellow. Well, if you click on the chart and you reference the interest rate differential, you'll see that the data we're looking at is going back to September 1997. And we're referencing here row 258. And if you go to the Aussie dollar variable, you'll see that we're referencing G258. So we're lining up all of the data to be exactly for September 1997. And again, all you have to do with these things is download the data, as we've shown you how to do, and put in the latest data for both US Fed funds rate, RBA interbank rate, work out by just auto filling down the interest rate differential, the daily rollover, and the synthetic number, and get your Aussie dollar, US dollar latest monthly data, as we've shown you multiple times so far in the video series, from investing.com/currencies. And most important thing here is to keep on top of it every month at an absolute minimum, but you may even choose to look at this on a daily basis as well. So you can always look at daily data and also weekly data. Now, if we go back up to the top of the spreadsheet, you'll see here we have a chart which is referencing our interest rate differential, but going back all the way to 1976. So this is including all the data going back to 1976. If you scroll down here, we're looking at our daily rollover data. So the chart is obviously going to be a very similar profile in terms of its shape, because it's just divided by 365, and that stays constant. And also we have our synthetic rollover here, which is obviously going to stay the same shape because it's a constant number times the constant 100,000 currency pairs. We also have our scorecard here, which we'll go to in a second when we get to going over to the presentation again. But just recall, it's very important to stay on top of these numbers, because the number that you're looking at here in synthetic, if you're long, this is what you're receiving. If you're short, this is what you're paying out. So that's the first thing you have to be on top of. You have to always be on top of the number. And again, this will be available or should be available on pretty much all Forex trading retail brokerage platforms. If it's not, then it should either be available on the website, or you may have to email in to get their rates sent to you as a PDF. they're under a regulatory obligation to tell you this stuff. So they have to tell you in whatever format they need to. But you need to be on top of this stuff for those two very important reasons. One, because this is the amount that you're going to receive if you're long, or short if you pay out. And two, it's under the broker's regulatory obligations to tell you this stuff. So we don't want to fall for any broker tricks that this information is not being made available, or the rates themselves are wildly different or not calculated properly. So let's go back over to the presentation and start to tie all this up together and start building our scorecard. So if we just navigate back over to the presentation and maximize everything. And as a reminder, let's just go over what this actually means for us. Well, as the gap between interest rates in Australia and the US widens, this is basically creating hot money flows out of the US dollar into the Aussie dollar to obtain the carry, because the interest rate in the United States is getting lower relative to the interest rate in Australia. So the carry is becoming more positive. And this is essentially inflationary for Australia. So we have a long bias towards Aussie dollar, US dollar. However, our conviction does lower if the gap widens by too much, because authorities will more than likely intervene in order to avoid excessive speculation and to avoid hyperinflation. And the opposite rings true. As the gap between interest rates in Australia and the US narrows, this creates hot money flows out of the Aussie dollar into the US dollar because the carry is depleting. Essentially, interest rates in Australia are becoming less attractive to the United States. So hot money flows out of Australia looking for a higher interest rate, or relatively higher interest rate compared to the previous period in the United States. So the carry is depleting. The carry between the US and Australia is depleting. And this is deflationary for Australia. So we have a short bias towards the Aussie dollar, US dollar. And again, our conviction lowers if the gap narrows by too much, as authorities will have probably already intervened and inflationary conditions may start beginning to appear. So we have to lower our conviction the more this narrows on an extreme basis. So what's important here is a couple of things. Firstly, whether the carry is positive or negative, and also the direction it's moving in. So whether it's widening or narrowing. So if we look at the interest rate differential divided by 365 days, as we saw in the spreadsheet, what we get is the daily rollover that we either receive or pay out. So being long or short the Aussie dollar, US dollar exchange rate. And you can see here that throughout history, it's been the majority of the times the carry has been positive when being long Aussie dollar, US dollar, and negative when being short Aussie dollar, US dollar. So you can see here in the period from the late 90s to present day, we've had a positive carry, being long Aussie dollar, US dollar. And we had a negative carry here from the mid 90s to the late 90s, so small negative, which we would have paid out if we were long Aussie dollar, US dollar. And the reverse is true if we're short. In the positives, if we're short Aussie dollar, US dollar, this is what we're going to be paying out, and this is what we would have been receiving in the mid to late 90s. And when the carry is depleting, so in the negatives, it becomes more attractive to short the Aussie dollar, US dollar. And when the carry is going in the direction of widening, so interest rates in Australia are going up faster than the United States, so the gap is widening, it becomes more attractive to be long. So the two things that really matter are the absolute level, whether we've got positive carry or negative carry when being long Aussie dollar, US dollar, and the direction, whether it's narrowing or widening. And this is where the hot money speculation or speculative flows occur, because money in these instances will flow out of Aussie dollar into US dollar. And in these circumstances, when the carry is getting more positive or widening, this is when hot money will flow out of the US dollar into the Aussie dollar. So we need to stay on top of these things, obviously. We can also calculate the synthetic one lot example as we looked at in the spreadsheet. And obviously, this is going to have the same shape because the variables are actually constant. And we can see how much we're either paying out or receiving. So with a positive carry, at the moment, what we're receiving on Aussie dollar, US dollar, if we're long, is around $6 per day. But if we're short, that's what we're paying out. However, back here in 2011, we were paying out double if we were short and receiving double if we were long. So as this depletes, what you see is speculative money coming out of the Aussie dollar. And the same here, for example, when we look at 2007, 2008, we can see that long Aussie dollar, US dollar, we're receiving around $2–3 in carry per day, but this drastically increased to 2008, 2009, where we're now getting around $14 per day by being long. And if you were short, obviously you get the opposite. You were paying out $2 per day, but now you're paying out $14 per day. So it becomes more attractive to be long and less attractive to be short. So the two things we have to worry about here is obviously the absolute level as to whether the carry is positive, being long Aussie dollar, US dollar, or negative, being long Aussie dollar, US dollar, as to whether we get paid or we pay out. So that's a really important thing to concentrate on. Obviously, we have to have this always in the back of our mind, and we have to always check the brokerage platform. And again, that's for a couple of reasons. Firstly, checking the brokerage platform is just good due diligence, because the broker may be actually calculating this wrong, or doing it incorrectly, or even doing it on purpose to ensure that they're not paying out carry. So you need to be aware that a lot of tricks can be played on brokerage platforms by people who don't actually check these things properly. And the term that's used in the industry is called slippage, where money just occasionally goes missing from your account. So very small amounts of money per day that you wouldn't necessarily see if you were running a decent sized portfolio. That's the main thing. This second thing also is that we obviously don't want to be the wrong side of situations where hot money is going into carry trades and coming out of carry trades, because the big speculative money, that's the fundamental money, is looking at this and trading it on our timeframes. We want to be taking the same approach and actually lining our currency trades up where we actually do get a benefit from it. Or if we're paying out, the payout is becoming less, it's depleting, because that means hot money is flowing out. So in summary, what we want to be making sure of is having a look at the carry on a currency pair historically and getting a historical perspective and understanding the positives and the negatives and the magnitude of these positives and negatives. We also want to be understanding and charting the currency pair against the interest rate differential and the percentage rollover and synthetic rollover. We want to be charting the currency pair against this to look for the relationship of the carry and the value of the currency pair. We want to be looking at the magnitude of the positives and the negatives and the direction relative to the currency pair. We also want to be checking on our brokerage platform always what the current rates are for daily rollover, so we can make sure that we're leaning towards the right bias all the time. Now, we can have a look at the scorecards, and you can see again with the scorecards we have inflation in red going all the way up the scale and deflationary conditions all the way down the scale. But you will see a slight difference here between this scorecard and all of our previous macro drivers. You'll see that on the inflationary side, we tend to have a long Aussie dollar, short US dollar bias. And on the deflationary side, we tend to have a short Aussie dollar, long US dollar bias. Now, why is that? Well, it's because we're not looking at trading a currency in its entirety here. It's because of the dynamic principle, which is we can't buy one currency without selling another first. So when the interest rate differential between Australia and the US is widening, so getting bigger, we get an increasingly positive carry. And that's inflationary for the Aussie dollar, US dollar, and we look to go long. So on the left-hand side, we have our interest rate differential, and we have our inflationary scoring system going all the way up the scale. So as the interest rate differential widens in favor of Australia, we're getting hot money flows into Australia, which is inflationary, looking for the carry. And when the interest rate differential widens to extreme levels historically, our conviction scoring becomes lower. And then we may even switch to becoming deflationary, so going short Aussie dollar, long US dollar. So when we have this deflationary condition, so when the interest rate differential between Australia and the US is narrowing, so getting smaller, as we can see here on the scale, we're getting an increasingly more negative carry. Now, just remember, carry can still be positive, but just less so. So not going negative in absolute terms, it can still be positive in absolute terms, but the carry is depleting. And that's deflationary and negative for Aussie dollar, US dollar, and we look to go short. And as we have the extreme move in the deflationary area of our scorecard, so when we have the extreme narrowing of the differential between Aussie dollar and US dollar, our conviction scoring comes lower because we know that the authorities are going to step in and are probably already stepping in at that stage in an attempt to actually attract hot money flows back into Australia by attempting to manage the interest rate differential higher. So what is the current differential? Well, currently the interest rate differential as of Feb 2015 is 2.17%, and it's been falling considerably. So we scorecard a -4 as the currency trade is being, the carry trade is being unwound by the market. So we're seeing evidence that the interest rate differential is falling and the carry trade is being unwound. So hot money is flowing out of Australia into the United States. So that just about covers interest rate differentials and carry. If you do need to go back and complete all the groundwork again in Foundation, please do so, because this is pretty important stuff. But let's go over to the trading desk now for a quick recap on interest rate differentials and carry. Okay, welcome back. So relative to our previous analysis throughout the video series, I think this one is actually pretty straightforward when we look at interest rate differentials, carry and rollover. The most important two things that you need to know, obviously mentioned a few times in the video, is the absolute level of the carry, so whether the carry is positive or negative, and the direction that it's moving in. That's the second most important thing, because you can see that if it's positive and it's falling, this can actually be bearish or give us a short bias on currencies like the Aussie dollar, US dollar exchange rate. And if it's positive and rising, that can give us a long bias, so it can be bullish for Aussie dollar, US dollar. So the absolute level is key to know, and the direction it's moving in. And you can apply this analysis now to any currency pair and look at interest rate differentials, carry and rollover, and analyze it properly and be the right way round all the time. You know, right back at the beginning of the video series, we covered this in Foundation because it is one of the basic computational methods and analyses that you have to understand. But now we're actually looking at it in a bit more depth and actually scorecarding for inflationary, deflationary conditions in the case subject for Australia itself and the Aussie dollar, US dollar exchange rate through exogenous analysis and the dynamic relativity principle. So they're the most important things you have to cover. We got on our scorecard again, we got a deflationary number for the Aussie dollar, and we got a -4. So the -4 number is going to be added on to our overall exogenous scorecard, which we'll look at when we come to the end of the exogenous analysis. Also to point out, there were a few things mentioned there going through the video on the computer screen. There were a few things mentioned there about being the guy that knows this stuff and checking it all the time. Because what we don't want you to be is obviously the dumb money trader that we pointed out much earlier on in the video series when we covered this, who doesn't even know this goes on or doesn't even check it, because it is one of the most amateur retail trader errors to not understand the dynamics of interest rate differentials and understand what it really means. And it's a very bread and butter situational case for fundamental and smart money in the Forex markets. So if you're the guy that doesn't know this and you're making the typical retail trader error of buying and selling charts and running those positions overnight, you are going to receive or you are going to pay out carry. So you're either going to be long the carry or short the carry. And if you don't know what it means or you don't know it even exists, again, you could end up just being this guy that buys an exchange rate or shorts an exchange rate, doesn't even know that they're paying out carry or doesn't even know what carry is. And the exchange rate just stays the same price or even goes up and you don't even make money or you lose money. So it's very important to know this stuff. Also, if you don't understand and appreciate it properly, and you're just buying and selling charts and running positions in your brokerage trading platform for very long periods of time without any fundamental awareness of what's going on behind the scenes, there's some bad people out there, and brokers do take advantage of dumb clients. So you've got to check these things on your trading platform. Know that the rates are there or thereabouts, the correct rates, and the carry is actually correct. If it isn't, question it, send them emails, send them messages and question why the carry is negative if you go long and it shouldn't be, or vice versa. Always just check these things and make sure that the brokerage platform is actually crediting your account properly, or even debiting your account properly. Because even when you're paying out, you may end up paying out more, and the rate might actually be changed by the broker. So again, we covered this just on the computer screen, and we covered the area that we tend to call in the industry slippage. So what you need to be doing is, if you're long or short Forex pair, is knowing and understanding the carry, using it obviously in your advantage as a driver overall in your exogenous analysis and in your overall systematic framework. But also, because you're aware of it, you're aware of the negatives, and you always double check these things and make sure that the right rates are being paid or paid out on the brokerage platform. Okay, so now we're going to move on to our next section in the exogenous driver analysis. We're going to move on to stock market returns and relative wealth. So I'll see you in the next video.